thank you to those of you who are joining us today to hear from the Mpac Group with their full year results. We are going to run through a presentation from Tony Steele, CEO, and Will Wilkins, CFO. But I believe we're going to start with a video. So we shall put that on to begin with.
It was important for Mpac to open a facility in the US because our customers, the voice of the customer was very clear. They wanted local support and services. And for our potential customers going forward, it's an excellent facility and location to leverage the Mpac product solutions. Well, having the location here will enable us to service and support them better and allow us to create that platform to showcase our full solutions in automation and packaging materials across the USA customer base and potential customers. The growth expectations are really ambitious. You know, we moved into a facility here which is 3 times the size of the previous facility, and that's to give us the capacity to really accelerate the growth. And the growth will come from the USA market, but more broadly from the other range of products that Mpac can offer, so we can leverage those full solutions with our customers. This is also a tremendous facility for the employees. When we look at what we've created here, it will allow us to have a really first-class facility for employees, and it will allow us to attract the right talent to enable us to grow and to satisfy our customer needs in the future.
Before the acquisition from Mpac, one of our goals was to broaden our opportunities around the world and broaden the opportunities for our employees. And by joining Mpac, we've really realized both. Being part of a larger organization allows our employees room to grow in their careers and also expands the opportunities for us to sell switchback products around the world. Our customers have loved the move to this facility. It's a state-of-the-art location. The showroom that you see behind me has been a huge benefit to not only showcase our machinery, but also even run customer FATs here. And it just is really a show place for our products. Our employees have really appreciated all the amenities that we offer here compared to previous locations. So it's been a great benefit.
Well, I think first of all, when you think about this facility and what it means to the overall Mpac Group and some of the things that we're going to be utilizing, service is a key component to everything that we do for all of Mpac's product offerings. So this building will be utilized, for customer visits, prospects coming by. We'll be looking to facilitate spares and many other, service offerings through this building, all encompassing around service. The beauty about Mpac is that we are a global operation. When you think about the customers that we're dealing with, and in particular here in the Americas and the USA, we're dealing with customers that have global operations all over the world. And so when they come to Mpac, that's one of the real attractions, is the fact that we can help them, we can service them anywhere that they have facilities. And that's a really key message, to all of our customers. This facility here is just first class, and we should be really proud. Our employees are extremely proud. And I think it's just going to allow us to really, really build our platforms and our future for Mpac Group going forward.
Okay, well, welcome everybody, and thanks for spending the time today to join the webinar. I'll take the opportunity to take you through the last 12 months results, sharing some of the highlights, and we have 3 case studies to take you through there, which should give you some more color around what we're doing as Mpac Group and what our plans are for the future. Then I'll pass you over to Will to go through the financial highlights for 2021, and then I'll come back and talk about the outlook and what our plans are for 2022. So whilst we're waiting for the slides to catch up, maybe they're already caught up with you, I don't know, just to say, well, what does Mpac do? Well, we're a global leader to provide packaging and automation solutions used by the FMCG industry to package their products for onward storage and distribution, and finally consumption by the public. The equipment we supply maximizes product quality and process efficiency, and working sustainably to minimize waste. So we, in the value chain, we provide packaging and automation equipment for our customers to use to pack their products for onward distribution. If we go to slide 4, the highlights I'd like to pick out from 2021. The first thing is, it's a very good year overall, and we we can see that the strategy that we've put in place is starting to deliver, and we'll come back to that with the financial outlook. You can see the three, over the last 3 years, this performance has stepped up financially and has now got to a level where we will see that as a new platform to grow going forward in the future. So the first thing is the order intake. The order intake was really strong. We surpassed our target of 100 million last year, and that was brought about, again, looking back from the strategy. We invested a few years ago in an enlarged sales team in the USA. We followed that up by service investments. We acquired then the Switchback company just over 12 months ago, 18 months ago now, and we're really leveraging the sales around the USA. And it has to be said as well that the market has been more robust during the COVID situation. They have a very much business as usual mentality. But nevertheless, the order intake is really strong, and so are the prospects going forward. So it gives us a really good order book for 2022. The revenue is growth over the previous years as well, and again, comes back to the strategy. We invested £3 million or so in common engineering and ERP systems, and they're really coming to the fore now, helping us to not only drill down through our bills of materials and see what supply chain issues we have and what we need to do to relieve those, but it helps us to bring all our businesses together as one and share the resource pool across all the businesses, so that if there's one site that's maybe a little bit overloaded, we can spread that work around the other businesses. And that's been done on a daily basis now. We have engineers from one company working on projects on another. We have assembly going on one site that supports another site. So this is really coming to fruition. And then we look at the profitability. We got to a 9.3% return on sales last year. We can see the margin growing, and that's coming to fruition with our push into the healthcare market, our increased service offer, and also our efficiencies through the ERP systems that we can deploy and roll out. So overall, very pleased with the set of financial results. If we go to the next slide, please, slide 5. The change here for us is, for those who are relatively new, we now go to market as Mpac. We've changed the website this year, so our customer proposition is all around one Mpac and providing whole lines, full solutions for the whole life of the product, and in a sustainable way to look after the planet. So we have now 4 product lines. We have the 3 main equipment product lines, which is Lambert. We acquired that business 3 years ago, and that's the primary packaging and automation solution we have. And just to orientate you, if you look on the icons at the lower part of the slide, the first 3 icons, assembly, filling and dosing, and primary packaging, that's what we can offer from our UK Tadcaster facility. The other 5 icons are our secondary packaging or cartoning and case packing, end-of-line case packing solutions, and they can be offered from our Langen product line or Switchback product line. And then the 4th product line to augment all of that and to really bring alive one Mpac is the Mpac Cube. And the Mpac Cube is our service product line, rolling together legacy service products, but also now encompassing our digital technology service products as well. So overall now go to market as one Mpac, with 4 strong product lines, 3 equipment and 1 for the service side of the business. Can we move to slide 6, please? If I look to this slide, really the changes, or what I want to bring out as highlights, is the first thing is the sales by sector, healthcare and food and beverage. If you go back 3 years ago, 4 years ago or so, the food and beverage part of the equation was about 70%, 2/3 of our business, and about 1/3 healthcare. And we've been working hard to grow our healthcare business over the last few years to really put extra resources into that area, and also service solutions around healthcare. And you say, well, why is that important? Well, it's important because I think the customers get better utilization of the Mpac products. So we fit better, or we have product offers that suit that market. It tends to be higher barriers to entry into the healthcare markets, and they tend to be better margins than food and beverage. So it's not to say we're moving out of food and beverage. We're not. We are very strong in that area, but we wanted to balance our sectors and have an even balance. It's not. I don't think it's contrived. 48% on each side. And then on the right-hand side, you'll see that we've got our, it says Richfield, USA, probably a little bit confusing because I keep calling it Cleveland, Ohio, but Richfield is the district. And that facility is 3 times the size of the previous one, as you saw in that excellent video earlier. We've really got a lot of capability there to grow and to make the Cleveland site the headquarters for our USA business, offering all our product lines through there to really benefit the local customers in the US market. Okay, next slide, please. In terms of the business model has not changed. You know, this is where we focused. In terms of consultation, we do a small part of that. It's where you'll see that is when the customer's really not sure of the concept and they want to do some proof of principling, just to make sure that the concepts of the ideas that they've got work. But a lot of the time we do that as part of our equipment sales. We offer our sales guys, our sales team are very well able to consult and offer guidance to our customers on the optimal automation and packaging solutions. The main core of what we do is design and build. So this is engineering design using a portfolio of standard modules, but every customer product is different. So there is an element of design around the customer's products and the behaviors of that. So it's engineering, design, concepting, and then it's the software solution that we put around that before we can go out and procure the right components, the right OEM parts to be able to put the solution together for the customer. So the key parts there are the engineering and software design around that. And then we come into the install, monitor, and optimize, and this is our service products. And the monitor we brought out in the last presentation, and I'll say again, really, is the area where we'll see growth in the future. All our equipment now is Industry 4.0 capable, very able to generate the right levels of data and insight into the machine's behavior. And we now have a series of products that we can deploy with the equipment, and the customers can purchase and subscribe to follow the productivity, if you like, and the life of their equipment, and make sure that they optimize it throughout the equipment's use on a 24/7 basis. Go to the next slide, please. In terms of the end user markets, no real change. These figures were quoted from the American Trade Association in 2021, a $40 billion equipment market per annum. Is all that market accessible to Mpac? I would say no. It's a broad market, but we have got plenty of opportunity to grow, given that we're roughly 100 million turnover in pounds. There's lots of headroom, and the way we do that is through working with our core competencies, which is the solutions column, and then working in the adjacencies either side of that. And one example I'll bring out there is frozen foods. A few years ago, we did a lot of applications around frozen pizza. And once the know-how and the knowledge gets built up around frozen foods, then handling other frozen foods becomes a capability we can offer on a broader platform. So in the last 12 months, 2 years, we've done a lot around frozen ice creams, particularly in the US market. And the technologies around handling frozen foods slightly different, but once we've built up on that knowledge, we can expand it out into adjacent markets. The overall growth drivers for those markets remain remarkably resilient, 4-5% compound average growth over the medium term. And during COVID, we've seen those figures really not change too much. In the first wave of COVID, Q2, Q3 of 2020, we saw all the markets slowed down because clearly nobody really knew what was happening and what would be the sort of the rollout of COVID. But then we saw an acceleration of essential foods and healthcare. So these are low value but essential products for the consumers through our customers. And we saw a little bit of a tempering off of the more high value, high ticket items. But overall, the markets are strong, as you can see from our order book, and these are really resilient end markets. And the thing that we've seen of late is the third driver, and this is the drive for further automation, particularly the end-of-line case packing solutions, which you saw on a previous slide. And why is that happening? Well, that's happening because of labour shortages around the world, not specific to any one country. And the unavailable or the lack of availability of labour has caused our customers to re-look at the return on investments for case packing solutions and automation. Previously, that was a a more challenging area because there was available low-cost labour who could put cartons into cases and cases onto trucks. We're now seeing an uptick in automation, which is aligned with one of the case studies we'll show a little further on in the deck, where we've developed a line of case packers really in good time for that step up in automation in those areas. Next slide, please. In terms of strategic progress in 2021, I'll be a little bit repetitive because the three things I'll pick out I've mentioned already, but I think it's worth just reminding ourselves. The first one is on the going for growth in the Americas. And aside from the things I spoke about earlier, which 3-4 years ago in the strategic plan, we started to build up our capabilities there. The switchback business, we've now owned it for around about 18 months. And we've been really very pleased by progress. And why do I say that? Well, first of all, they integrated within the Mpac group, and they were not, they were a small privately owned company before. So integrating to a group is not easy. And I say it that way around. They had to integrate with the group. It wasn't the other way around. And they've done that. They've moved premises to a premises 3 times larger, as you saw in the video. And they did that whilst keeping the order intake in a good trajectory and the revenue building throughout that period. And the really pleasing aspect is the cross-selling now across the Langham switchback range. So quite often customers will now have a combined Langham switchback solution, which suits their budget, technology needs and desires. So that's really taken momentum in the USA market, and that's what we'll bring to Europe in 2022. I spoke about the Mpac Cube earlier. We've got a case study on that, so I'll leave it at that and come back to it in the case study. But I think that's a really good step forward to offer a service product line from Mpac as opposed to the different brands. And then the operational efficiency I spoke about earlier. We invested around £3 million over the last 3 years in engineering systems and ERP systems across the group. They're really now coming to fruition. I think they enabled our management to be agile and making the right decisions during 2021 in order to navigate through the supply chain difficulties. And more importantly than that, it's enabled us to improve our efficiencies and better utilize our 500 or so employees, as opposed to use contractors when one site is overloaded and maybe when another site is underloaded. So to balance resources across the group has been a really strong point. If I look towards 2022, looking ahead, I just mentioned really EMEA and leveraging the switchback product. We're doing a lot of preparation for that launch. We've already soft launched it using social media. We've got a trade show coming up in the next couple of weeks, and we've got product being manufactured so that we've got that launch for 2022 in Europe. In terms of product innovation, we've got an exciting portfolio of product development, not least the cardboard tray development for a number of our large FMCG customers to replace plastic. But the battery cell automation, again, we have a case study on Freya to give you an update on that, so I'll come back to that. But a really good, vibrant product development roadmap going forward. And then the third one I'll mention on the look ahead is the skills side of it. We're launching this year the Mpac Academy. And what does the Mpac Academy do? Well, that's twofold. It's all about attracting the right talent and retaining the right talent in the business. So to attract the right talent, we already do it on a site-by-site basis, attracting undergraduates to join Mpac and do their sandwich year, their year placements with an industrial partner, so with us. And we've seen that has a very high success rate of those talented young people joining us after they've graduated. We want to leverage that across the Mpac community of the 4 businesses. And what a fantastic opportunity for a young undergraduate to join a company where they can maybe spend some time in the US, in Canada, in Europe, in the UK. And then to add to that, we want to develop our own internal talent for the next stage of leadership. So we'll pick out key high potentials within the different businesses, and we'll put them on an in-house training program to get them to be very capable to be the next level of leaders in our business. Next slide, please. So yeah, I spoke about the Mpac Cube. Just to remind ourselves, what is it? It's a product line. It's our service product line. On the right-hand side of the slide, you'll see there the core services and training. These were our legacy service products that we offered. And when Will talks about the financial numbers, you'll see that in 2019, our service offer really stepped up. And that's where we embedded it in our equipment sales. And of late, we've employed business development directors in the different regions to really spend time with customers and understand their needs. So our service revenues have been growing anyway, but the 4 products on the left-hand side, the advanced engineering, connected services, information management, and machine insight, these are all digital technologies which will position Mpac to take this story one step further in terms of really helping our customers. And just to give one example, advanced engineering, this is where we're deploying the technology called digital twin. And what does the digital twin do? Well, this is a virtual 3D or model of the equipment that will eventually supply to our customer. And that helps us and the customer at the onset to ensure that the concept is a good concept and it's a workable concept for their needs. It then rolls into the software development, so it helps accelerate the software development that's needed for that solution. It then helps with the commissioning and reduces the time in the factory to make a factory acceptance test. And then the residual value continues to the customer site to help with an increased speed of ramp up. So the commissioning phase in the customer's facility takes shorter time. It then becomes a training module to help other people train. And then one step beyond that, it helps the customer to try out different scenarios in the future when they want to improve the productivity or enhance the solution. So that digital twin technology is a really great way of partnering with the customer from cradle to grave all the way through the life cycle of the equipment. So we're really excited to launch that, and that's now on our website if you need any more details. The next case study, this one is really pleasing. Why? We looked at our product portfolio 3-4 years ago, and we saw that there was a gap in case packing, end-of-line case packing solutions. This is where the cartons then go into cases for onward distribution. And we thought, well, what should we do with this? We could buy a company to fill that gap. And then we looked at it more closely and we said, well, we've got all the technologies we need, and we actually understand the customer's need, which was the most important thing. So talking to our customers, and this one's Nestle as an example, we really understand their requirements. We understand the flexibility that they're trying to develop, so multiple applications on the same piece of equipment. We already understand what was needed to have it Industry 4.0 enabled. So working in conjunction with a number of our large customers, we developed a range of products, and this has gone from concept to sales in 2020, 2021, and we're now a preferred supplier for this with this solution with Nestle, which will yield multiple projects each year. So I think that's a really great case study to show the innovative power of Mpac going forward. Next slide, please. Yeah, and then we come to Freya. We announced this contract win in the half-year results last year. Just to remind ourselves, the situation and what's it all about. Well, 24M are a technology developer, so they started as an incubator company developing a low-cost lithium-ion battery cell, and we've been working with them for about 4 years on proof of principle and industrialization work to get their product to a state where they can license it to other people. One of their licensees is Freya, which will be the end customer, but they have around more than 12, I think it is, licensees, and they've just entered a license agreement with Volkswagen as well. So 24M are a highly credible player in the technology side, licensing this to end users, of which Freya are one. Freya placed a contract with Mpac last July, and that was for a development line or a customer qualification production line for their Norwegian facility. That's due to be delivered by the end of this year. The market opportunity in battery cell automation is vast, it's huge, but it depends on obviously what's accessible and what take you have on that market. So working with 24M and Freya, there is a huge opportunity going forward in the next 5-10 years. Where we're at the moment is we're still working on the development line. That's due for shipment at the end of this year. The technology is still in a state of development, and we're working hard with Freya and 24M to have a partnership agreement which confirms our position in that supply chain. That's the current status. Also, as Mpac, we will be developing a generic solution to the battery cell automation needs of the market, so we can go to market and position ourselves as a key equipment and services provider to that market going forward. So it's a really exciting space. We're well positioned at the moment where we are with this development line, and we'll keep you posted as more news flow comes. So if I just have a quick word on the next slide about sustainability, and then I'll pass you across to Will. Just to be clear on where we are as Mpac, we're obviously we're a public company, so we have a high level of governance and control anyway. In terms of sustainability, we're working on our strategy around sustainability, and we'll set some targets which are in line with our strategy by the end of the year. But as a positional statement where we are, there's an inverse relationship between Mpac and our carbon footprint and that of our customers, and further downstream, the consumers. Clearly, in the consumers generate an awful lot of waste product in terms of packaging materials that needs to be reduced. And our position is to work with our customers on more sustainable variations and options for packaging. But as importantly, and maybe more importantly, is to work on the machine and the equipment efficiencies, because a 1% improvement in efficiency will have a massive impact on productivity, energy reduction, and waste reduction, because the lines are not stopping and starting too often. So our position is to help our customers to improve their productivity. And as Mpac, we'll be setting targets in this year, along with our strategy, to follow this story going forward. So on that note, I'll pass you across to Will to take you through the financial numbers, and I'll come back to you and talk about the outlook after that. Thanks, Will.
Okay, thank you, Tony. So we start on the next slide, please, Hannah, on the financial highlights. So we're presenting, I think, a very strong set of financials for the year, with growth in order intake, revenue, profit margins, and underlying profit. Having a look at order intake, as Tony's mentioned, really strong year, 41% growth over prior year to 118 million. Where's that growth coming from? Well, primarily it's our original equipment product line that's generating that growth, and the largest region remains the Americas. And in Americas, very strong year, 27% growth overall in order intake. But equally as pleasing has been the recovery or rebound in EMEA and APAC. So whilst they still represent smaller regions in terms of the quantum of order intake, the growth in EMEA and APAC has exceeded the Americas. So it's pleasing to see that rebalance. And EMEA is up 77%, APAC is up tenfold. So it gives some sort of context to the rebound. And to our recurring service business. So order intake for service, broadly unchanged on the prior year, but in the context of the ongoing travel restrictions, we see that as a reasonable outcome for the year. Looking at revenue is up 13% to 94.3 million. And again, that's somewhat impacted by challenges in global supply chain in the last quarter, maybe last 2 quarters of the year, where there's been lengthening lead times from our supply base. So that's been able to report that level of growth over the prior year. Again, we see that as a very positive outcome for the year. Probably not surprising that regionally it's the Americas that's strongest, again in line with the strength on the region's order intake. But that combination of really strong order intake and revenue 94 million, that's helped generate a closing order book of 78.4 million, up from 55.5 in the prior year. So that gives us a really good level of coverage over our 2022 revenue forecasts. We touch on margins and profitability. You see on the graph on the right hand side there, gross profit margins exceeded 30% last year for the first time. That increase, what's it driven by? It's underpinned by that balance of revenue profile coming from healthcare and food and beverage, and that weighting back towards healthcare. Healthcare related projects typically carry a slightly higher premium in terms of margin for us, and that's been one of the drivers. But also, it's the impact of implementation of one Mpac and that approach to operate as a single entity business unit, which means we can leverage the resourcing pools across the group and help to drive efficiency and underpin that growth in margin. So that improving margin outlook and continued cost controls has flowed through to an increase in operating profits to 8.8 million, up from 6.5 in the prior year, and underlying PBT of 8.6 million, up from 6.3 in the prior year. Operating cash inflow was 0.4 million. That includes an increase in working capital, and there's a slide a little bit further on the pack which will give a bit more detail and colour to that. And we're reporting closing cash of 14.5 million, which is in line with the market guidance and a good outcome for the year. That flows through there to underlying earnings per share of 39.7p. There's a little bit more detail on the next slide, and if you go to regarding the group income statement, you can see hopefully on the right hand side there the growth in original equipment, up 16% on the prior year. Service revenue up 3%. Our service revenue includes field-based revenue streams such as installation, commissioning and field service. So the restrictions on being able to get to our customer sites is the background for that 3% increase in revenue. Looking at our cost base, a little bit more: selling and marketing costs, distribution costs, admin costs. Across the two, you see an increase compared to the prior year, but to give a little bit of context to that, the prior year cost base includes some government-related COVID support in the jurisdictions that we operate, which was in the magnitude of about 2.4 million. And also the 2021 numbers include a full year cost base of the switchback operation. So I think what we'd like to get over here is that the increase in revenue has been driven by leveraging the investment in the cost base rather than a flow through fully of costs. And the underlying operating margin, we set an aspirational target some time ago to hit 10% return on sales on an underlying basis. In 2021, we're reporting 9.3%, so we're well on track to deliver that longer term aim. Non-underlying items, the one item I would draw out here is in the year we have released the deferred consideration regarding the 2019 acquisition of Lambert. That was 2.4 million. We set some challenging targets on the acquisition. The outturn came in just slightly below that target threshold, and therefore the full release of the deferred consideration has been recognised in 2021. And our underlying marginal rate of tax, just over 8%. That reflects the fact that we have access to some tax losses, mainly in the US and the UK, and we continue to optimise the utilisation of those losses and credits. Next slide, that's it, thank you. Two items here, which are the main drivers to movement in the balance sheet. So the net pension asset has increased significantly. So that's driven by strong scheme asset returns and an increase in the discount rates by 0.4%, and that's partially offset by some changes to mortality assumptions, and there's been some increases in mortality tables. So the combination of those three factors has driven the increase in scheme assets. And then on inventories, we're reporting a 2 million increase. That's a managed increase. We're working hard with our operations teams to ensure we're optimizing our project lead times. And that increase in inventories is there to help manage inventory levels to reduce any extension to project delivery times that we're currently working with. The other items related to working capital, so it's probably easier to talk about those on the next slide, please, Hannah. So if we look at the bridge on the right-hand side, looking at the opening cash to closing cash, so we opened with 15.5 million. We've spoken about the profitability in EBITDA, which was 11.6 million in the year, and then working capital. So I think this needs to be considered in the context of the working capital movement in 2020, where we reported a reduction in working capital of 7.5 million, sorry, which at the time was driven by a significant value of customer deposits in Q4 of 2020. So as those projects were executed, there was a natural unwind of that reduction in working capital in 2021. I think it's also fair to say, for those who've looked at the financial statements in more detail, the contract asset balance has increased in 21, and that's due to timing of projects as they approach the end of the year, where there was significant milestone for billing associated with factory acceptance testing around the turn of the year and into the month of 2022. So that build up in contract assets as the approach and hit an invoicing milestone converts to trade receivables. As those projects were approaching the year, those that didn't hit FAT, that's been the main driver to an increase in contract assets. And then if you look further down the waterfall, pension, 2.6 million is our ongoing commitments to the pension scheme, and CapEx of 1.7 million, which is mainly associated with the fit out of the US showcase facility. You saw the video at the beginning of the presentation. And there was some final costs associated with our implementation of ERP and business systems, but that investment cycle has now broadly reached an end, and we'd expect that to reduce in 2022. So overall, I think it demonstrates a really strong financial performance in 2021. We've got a strong balance sheet. We remain debt free, with the caveat of some preference shares. And we've got the access to liquidity to support our strategic initiatives that we plan to deliver upon in 2022. And we have a fantastic opening order book, which gives us really good coverage over the revenue forecast. So with that, hand back over to Tony.
Yeah, thanks, Will. I think it's just worth reminding ourselves about that. A really good order book, which starts for the start of 2022, and that's supported by a good prospects pipeline. We monitor every month our prospects pipeline, which is in front of the orders, if you like, and our customers are talking about projects 6, 9, 12 months ahead of the project. So by monitoring that pipeline, it gives us further confidence of where the business is going to go over the next year or two. So we remain really excited about the opportunities that are in front of us. Our key focus remains on healthcare, nutrition and beverage, in a more joined up way, fully exploiting Mpac. The one Mpac, as you've heard today, in terms of the strategy, is really starting to deliver and be in place now as a foundation for future growth. And we can see that all the markets that we face have remained resilient and of long-term growth drivers. So with this solid base of great products, blue chip customer relationships and innovative colleagues, this would be really well complemented by acquisitions, which we do still have a good acquisitions pipeline. We continue to monitor that. These businesses would typically be enhancing to our customer proposition, and where we can see for Mpac a way of leveraging future growth. So all in all, we're making really good progress on our strategy. We are very confident about the next 5 years to continued growth of the Mpac Group. Very well financed, as Will said. So there's all the fundamentals are in place for the stories to continue. So thanks for your attention today, and we'll turn you back to Hannah for Q&A.
Thank you for that canter through, and we've got plenty of questions. So let's make a start.
Excellent order intake. Are these projects projected to deliver the same higher or lower gross profit than the 2021 revenue?
Well, the balance in the order book is as per the balance that we showed in the revenue side of it. So we would expect the margins to continue that story. And as we said earlier, we're growing our service revenue and we're growing our healthcare side of the business. So we would expect the margin story to continue to evolve positively.
He did say that question was directed more about gross profit as a percentage rather than an absolute You might have answered, but I might have missed.
I think it was the same answer. Yeah, we see the gross profit improving going forward. It'll be the same in the order, but we do see it going forward improving.
Thank you. In the order intake, how much is from existing customers upgrading their machinery, and how much is new customers?
That's an interesting question, and you know, maybe the answer is not as precise as probably you would like on that. But where we are is our customers. Some customers invest every year, and we use Nestle as a case study before, so we can say we win, you know, multiple projects every year with Nestle, so they're an ever present. Why? Because they've got so many facilities around the world. They're always looking at an investment cycle. The next tier of customers may invest every, you know, they'll invest in quite an upgrade of equipment, and then they may have a hiatus for 3 years or 5 years. So we see them coming back periodically. And then there are new customers, which is really exciting. And, you know, the new customer side of it is coming a lot from the USA. We brought on board a new sales team to focus on the USA market 4 years ago, or 3 years ago, actually. And from a standing start, they've developed a really good level of order intake. And these are all new customers to us. So it's a really nice, healthy balance of new customers. And I would say probably 25% last year was completely new customers to us.
Okay, good. And do you sort of have a rolling metric by where you judge how much of the install base is likely to upgrade over the next few years, and what sort of ROIs those customers typically achieve?
We have a very detailed sales process that looks at investment cycles. A lot of our customers are blue chip and do send quite comprehensive reports to their financial authorities. So we can view their investor presentations and what to get at a high level. But our sales team, that's daily work for them to sort of drill down on the investment plans of our customers, and that builds into our forecast and our pipeline. What was the second part of the question, Hannah?
What sort of ROIs do these customers typically achieve?
They're typically looking at 3 years and less. If it goes over the 3 years, it tends to go into the long grass until a solution can be found that brings a return less than 3 years.
Okay, thank you. An inflation question. What percentage of cost of goods is accounted for by raw materials, and how quickly can you pass them on?
Well, we'll do this in 2 parts. I'll talk about how quickly can we pass it on, and I'll go back to Will for the percentage. You know, our business model is quite dynamic. I say quite, it's not 100% dynamic, but we only have quotes that are valid for 30 days. So the customer has an opportunity to place an order within the 30 days, or we will take the opportunity to re-quote. Our solutions are not apple to apple comparisons with or comparable with our competitors. Our proposed solution will be different for somebody else's. So we have got a certain strength in our pricing model to be able to differentiate. So with our short quotation period and our ability to look for solutions that's specific to the customer, we're not immune and protected from price inflation, but there's a short window of time between the quote being valid for 30 days, the customer placing the order, and we ordering the longer lead time, expensive OEM parts. So it's a relatively short. We managed to manage that reasonably well over the last couple of years, as you can see with the margin improvement. But we're not immune, but in a good place. I'm going to pass you to Will to talk about the percentage of our product cost.
Yeah, as a percentage of the order value and covering material costs, OEM parts, catalogue parts, it's about 35% of the order value is associated with with those categories of materials or spend.
Okay, thank you. Of the 12.7 million of contract assets at the year end, what value remains uninvoiced?
Oh, that's a very specific question. Okay, well, I'll turn that question around to talk about the projects that were open at the end of the year, which have not passed FAT and therefore hit a billing milestone, and try to attribute that back to put a pound value on it to answer the question. So about half of the projects that we had at the end of the year, and I've just done a little bit of due diligence whilst I saw that question popping up on my other screen, about half of the projects have yet to hit the FAT because there was a range of stages of completion. So, and it's slightly more than half in terms of value of that 12 million, which has yet to hit the milestone, which would move it on to invoice.
Okay, thank you. If the pension fund is in surplus, why are you paying cash into it?
Well, we're paying cash against not against the accounting surplus, but against the actuarial deficit. And unfortunately, that's a requirement for us to fund an actuarial deficit with a schedule of contributions, which we agree every 3 years with the trustees. And the last one was related to the 3 years ended June 18. We're in the process at the moment of agreeing the new schedule of contributions for the period to June, or from June 21, which should hopefully be concluded on or around the time we publish our interim results this year.
Okay, thank you. Can you comment on how you get such a high return on plant and working capital?
Sure, yeah, I think it's looking at the business as being not a capital intensive business. We consider ourselves as a integrator and a software provider and a solutions provider rather than a capital intensive business, and that's really what supports that high return.
Okay, thank you. Looking at staffing, obviously we know we're at there's a lot of vacancies out there. Have you got any problems attracting and retaining staff? Have you had to see some wage inflation? And how did the government financial support unwind for you?
Yeah, we are not immune to staff issues in terms of the flexibility and mobility of staff at the moment. Highly qualified technical staff have always been a challenge for us. More so recently because of COVID situation, people working from home, and also the advent of Tesla and Amazon. And they say, well, that's very specific, but there is a Tesla factory near our Mississauga plant that's been happily trying to approach people, and we have an Amazon warehouse going up near Leeds, near our Tadcaster facility, and they're also proactively trying to recruit people. So we have to live in this world this year. We know that we're looking at our overall employment conditions across the various sites, and flexibility is the number one request from our staff. So we are trying to accommodate flexibility whilst still having a need to have our people really in the same working place, so that they can learn together and on project management, work together to solve all the small issues. In terms of wage inflation, our budget was around 5%, which we fully expect it to be this year, because inflation in all the places we're operating is running at quite high, and that comes back to our pricing model and whether we can pass that on, and we feel as though we can to our customers. You know, it's a situation that the industrial world's all facing at the same time.
No, thank you. When or if do you plan to start paying a dividend?
Well, it was on our mind as a board to we talk about it twice a year to reflect on should we now be paying a dividend, and the conditions have been met, but we still in this situation where we want to retain the capital cash in the business for organic growth and for potential acquisitions. So there is also quite a challenging environment at the moment, so we feel as though it's better to keep our reserves in the business, and we'll come back to that at the next time we discuss it as a board.
Okay, thank you. Contract assets are up significantly, but contract liabilities are down due to the unwinding of projects. Can you add clarity to the seeming different directions?
Yeah, there's another item in there which causes this slight lack of transparency, and that's the timing of customer deposits. So it's not just about the movement of contract assets and liabilities, which should broadly mirror, depending upon the margin mix and depending upon whether the timing of billing payments, but it's customer deposits as well, which get reflected on the liability side. So that makes it not necessarily a clear correlation between the two.
Okay, thank you. Recurring revenues, are all of the OE revenues one-off, or do any have a recurring nature?
They're all, well, technically they're all one-off, but we do have contract or agreements, partnership agreements with several of our larger customers. So how does that help? That helps because we've already agreed technical specifications in the broader sense of the user requirements. And we've already agreed terms and conditions, so pricing, legal terms and conditions. So by having these framework agreements with several of our larger customers, it enables us to go straight to the concept engineering and order phase, as opposed to all the surrounding stuff. So not guaranteed to win the next project, but by having the agreements in place, it certainly puts us in pole position.
Okay. And final question then, obviously the events in, oh, maybe not the final one, does the events in Ukraine and Russia have any impact on existing or expected orders?
No, we have very low. We had one order through an agent, actually a US agent, that was destined for Russia, but that's now been changed to a different location via the agent. We don't have any supply chain coming out of Ukraine or Russia. So in in terms of short term, no impact to Mpac. I think what we're all conscious of, and the reason why we're taking quite a cautionary note into 22 is that this will inevitably lead to price inflation because of the price of oil, and that goes into lots of raw materials, energy costs, and then other things that could come our way as a consequence of that. So no direct exposure, but concerns on the wider front.
No, thank you. This gentleman was very impressed by the professional and polished product demonstrations given online. Will you be returning to physical trade shows? Because obviously they're expensive and costly, or can you do as good a job online?
I don't think you can. Is my, I think, personal opinion and the way we're going as a business, but we will not be attending as many trade shows as we did previously. I think what we will do is go to the flagship trade shows. So in the US and in Europe and in Asia, but we won't be going to a lot of the smaller ones because, as was commented there on the board, we can do a very effective job now at virtual trade shows and customer demonstrations because of the technologies we have. But there's nothing beats face-to-face conversations to start a new relationship with a prospective new customer.
Yeah, that's fair. I think this sort of leads on from your comment on the dividend and potential opportunities. Obviously, volatility can lead to problems, but yeah, also M&A opportunities. And with your strong balance sheet, do you think there's an increased likelihood of you executing on some?
We have an interesting product portfolio. Sorry, a pipeline of prospects for potential acquisition. As I've said probably previously, most of the targets that we have, in fact all of them, are off market, so they're not in process, so there's not a timeline that we can actually stand behind. And a lot of our time goes into building the right relationship with the target so that they feel as though we would be the better parent going forward. So we have a pipeline and we're pleased with that, and we hope to bring some of that to fruition in the near term.
Okay, thanks. We're all aware of the journey of removing plastic from our packaging. Obviously, how's that helping to support the business, and where do you think we are on this journey?
Yeah, as I commented on the slide presentation, there's an inverse relationship there. So, we can do so much to help our customers, and what we can do is certainly work on simpler formats, thinner materials, but more importantly, work on the overall equipment efficiency. So this is preventing the machine stopping on a regular basis, and that's not a reliability issue. That's usually product and packaging materials as an issue, or other issues like operator unavailability. So being able to use our Industry 4.0 modules to help the customer to monitor his equipment, to get insights from the data and learnings to improve their productivity, is an area where we can really, really help our customers to improve their sustainability credentials.
Great. Well, thank you, gentlemen, for your answers today. Thank you all for attending. As a reminder, we did publish a note at the back end of last week once Mpac announced their results. And otherwise, we look forward to catching up with you in 6 months' time. Thank you.
Thank you, everybody. Thank you, Anna.